All right, folks, get ready because we might be witnessing the start of a mortgage war. That's right, a battle where the banks throw down in a no-holds-barred that's guaranteed to be more entertaining than Mike Tyson versus Jake Paul. Now, that might be an exaggeration, but trust me, you're not going to want to miss this. Hey everyone, welcome back to the channel. If you're new here, my name's Myles Nowik of the Nowik Mortgage Team powered by Indy Mortgage. And today we're talking about why Canadian banks might be duking it out over your mortgage. And no, this isn't just some kind of banker fight club, though I'd probably pay to see that. It's about real competition that could mean savings for you. So let's dive into it. Here's the scoop. Canadian banks could be headed towards a full-blown mortgage war. Why? Well, interest rates are coming down, which is good for all of us. But with more than half of all mortgages in Canada coming up for renewal in the next 2 years, banks are getting, well, let's just say they're getting a little bit itchy. They want your business, and they're about to start swinging around rate cuts to get it. After the wild ride of inflation we've been through, people are definitely going to be shopping around for the best deals when it comes to their mortgage renewals, and the banks know this. If your current lender isn't offering you a deal that you think you deserve, you can bet someone else is going to be willing to. But what does this mean for us, the average Canadian? And why are banks suddenly so keen to fight for your business when before they seemed like they weren't? Let's break it down a little bit. Earlier this year, the Bank of Canada decided to cut interest rates not once, not twice, but 4 times. They were trying to ease up on pressure after keeping rates so high for so long while they were battling inflation. And with these cuts, the focus has shifted. Instead of worrying about mortgage payment shocks, those nasty surprises where your payments suddenly go up, it's turning to a point where they're looking at it all about renewal competition. Here's where things get interesting. Over the next 2 years, about 55% of Canadian bank mortgages are coming up for renewal. That means millions of Canadians will have the chance to renegotiate their mortgage rate, and trust me, you'll want to get the best deal you can. Banks are likely going to start trying all sorts of tactics to keep their customers, or better yet, steal them from each other. This could mean better rates, better products, and better mortgages all around. And with new rules removing the stress test for those looking to switch lenders at renewal, moving your mortgage has never been easier. Speaking of stealing customers, here's where things really kind of heat up. Toronto Dominion Bank, aka TD Bank, recently got into a bit of trouble south of the border, like $3.1 billion worth of trouble. Ouch. As a result, they've got some restrictions on their growth in the United States, and rumor has it they might start pushing extra hard on mortgages here in Canada to make up for it. They're going to need to make those dollars work somehow, and it could be your renewal that they're eyeing up. But TD isn't the only one. All the big banks are in on this. They know that mortgage products are one of their bread and butter products in their institution. And with loan growth slowing down elsewhere, like car loans, credit cards, and lines of credit, they see this as an opportunity. Bank of Montreal, Scotiabank, CIBC, they could all be at risk of losing customers or seeing their margins squeezed, which means they'll do whatever they can to keep you on board. Lower rates, better offers, maybe a free toaster. Okay, maybe not the toaster, but you get the idea. So what does this all mean for you? Well, if you've got a mortgage renewal coming up, you're in a pretty sweet spot. You might just see banks coming to you, each trying to outdo the other with the best rates possible. It's kind of like speed dating, but instead of charming conversation, you'll be talking to bankers, drooling over your mortgage like it's some kind of juicy steak. And it's important to remember, this competition is good for you as the consumer. It means you've got options and you should be ready to explore them. And what's the best way to explore them? It's to use a mortgage broker. If you go to RBC, you're going to get an RBC mortgage. If you talk to CIBC, they'll show you CIBC mortgages. When you talk to a mortgage broker, they're going to show you all the mortgages, and not just mortgages from the big 6 banks. Mortgage brokers have access to over 50 different mortgage lenders, all striving to earn your business. And lots of these lenders are able to offer better rates, better products, and lower potential costs if you break your mortgage term or change lenders early, like significantly lower. We're talking thousands and thousands of dollars. And the best part, with one conversation, you would have access to all these different lenders. No more running from appointment to appointment trying to pit banks against each other. Mortgage brokers do all of this for you. And for a traditional mortgage, they don't even charge you to do it. So here's my advice. Don't accept the first offer that comes your way. Shop around and definitely talk to a mortgage broker. Hey, like me. And make sure you're getting the deal that works best for you and your family. You should be looking at least 3 to 5 lenders and 5 mortgage options and have them presented to you so you're guaranteed to know what's available and what's best for you. If you want a tailored report outlining exactly this, click the link down below to schedule a call with our team. And if you found this video helpful, consider hitting that like and subscribe button to the channel. Now, my question to you, what do you think about these potential mortgage wars? Are you ready to see the banks fight it out for your mortgage? Drop a comment down below and let me know what you think. Thanks so much for watching. We'll catch you on the next one.